Between 2008 and 2016, major banks paid over $2 billion in fines for precious metals manipulation. Not alleged manipulation, proven manipulation, documented in court records, admitted in settlements, confirmed by regulatory agencies. That's not conspiracy theory, that's public record. But here's what they didn't tell you in those headlines. The manipulation never stopped, it just evolved. It got quieter, more sophisticated, more distributed, until now, because something is changing. The old playbook is breaking down, and the mechanisms that worked for decades are showing cracks. And if you hold silver, or you're thinking about it, you need to understand what's actually been happening. Not the YouTube version, not the forum speculation, the documented, provable, on-the-record version. Because when this system finally breaks, it's not going to break slowly. This is educational content about market structure and documented regulatory actions. Not financial advice, not conspiracy entertainment. Facts. Let's start with what actually happened. The cases they settled. JP Morgan, Deutsche Bank, HSBC, UBS, Barclays. These aren't small players. These are institutions that handle trillions in transactions. And between them, they've paid massive fines specifically for precious metals market manipulation. Not once, repeatedly. In 2016, Deutsche Bank settled and agreed to cooperate with investigations. They provided evidence, chat logs, trade data, internal communications. What they revealed was a coordinated effort across multiple banks to manipulate precious metals prices through a practice called spoofing. JP Morgan's case was even more interesting. In 2020, they paid close to $1 billion to settle charges that their traders engaged in thousands of instances of spoofing and manipulation over nearly a decade. Thousands, not a few rogue trades, a systematic pattern spanning years. And here's the part that should make you pay attention. These settlements covered activity that went on for years before it was caught and prosecuted. Which raises an obvious question. If it took years to catch what was happening between 2008 and 2016, what's been happening since? The regulatory agencies didn't suddenly become more vigilant. The banks didn't suddenly become more ethical. The incentives didn't change. What changed was they got smarter about hiding it. But before we get into what's happening now, you need to understand how the manipulation actually worked. Because once you see the mechanism, the current market behavior starts making a lot more sense. How spoofing actually works. Spoofing sounds technical, but the concept is brutally simple. You place large orders you have no intention of filling. These orders create the illusion of supply or demand. Other traders see those orders and react. The market moves in the direction you want. Then you cancel your fake orders and take the opposite position at the new, more favorable price. It's market manipulation disguised as legitimate trading activity. And it works because most market participants can't tell the difference between real orders and fake ones until it's too late. Here's a concrete example. Let's say silver is trading at $30. A manipulator wants to push the price down to buy cheaper. They flood the sell side with massive sell orders at $30.10, 20 cents, 30 cents. Other traders see this wall of supply and think, someone knows something. There's massive selling pressure coming. So they start selling too, trying to get out before the price drops further. The price drops to $29.80. The manipulator then cancels all those fake sell orders and buys aggressively at the lower price. They never intended to sell. They just wanted to scare others into selling so they could buy cheaper. That's spoofing. And it happened thousands of times across precious metals markets. Now overlay that with another tactic called wash trading. That's where the same entity trades with itself across different accounts to create the illusion of volume and price movement. It makes the market look more active than it is, or pushes price in a specific direction without any real underlying supply or demand. Combine spoofing with wash trading, add in coordinated efforts across multiple banks, and you get systematic price suppression that's nearly impossible to detect in real time. By the time regulators catch on, the damage is done and the profits are banked. But here's where it gets interesting for anyone watching the market today. The mechanism is breaking down. Manipulation doesn't work in a vacuum. It works when the underlying market has enough liquidity and enough participants who react predictably to price signals. Spoofing works because it exploits human psychology and algorithmic trading patterns. It relies on creating fear or greed at exactly the right moment to trigger a cascade of predictable reactions. But what happens when the market changes? What happens when the participants stop reacting predictably? What happens when physical demand becomes so strong that paper games can't move the price for long? That's what we're starting to see. And the evidence isn't speculative, it's behavioral. First, the smashes are getting bought faster. When silver gets hit with coordinated selling, it used to stay down for days or weeks. Now it recovers in hours. That's not random. That's structural demand showing up consistently at lower prices. Someone, or multiple someones, are treating every dip as a buying opportunity. Second, the premiums on physical silver relative to paper prices are staying elevated. In a normally functioning market, arbitrage would close that gap quickly. If physical is trading at a significant premium to paper, traders should be able to buy paper, take delivery, and sell physical for a profit. But that arbitrage isn't working smoothly anymore, which suggests either delivery is becoming more difficult or the people buying physical aren't interested in selling back into the paper system. Third, delivery volumes on futures exchanges are behaving strangely. More contracts are going to delivery instead of being rolled or cash settled. That's not normal behavior for speculators. Speculators rarely take delivery. They trade the price movement. When delivery volumes spike, it means someone actually wants the metal, not just exposure to price. And fourth, we're seeing more documented cases of delivery delays, tightness in specific product forms, and regional price dislocations. None of these are smoking guns individually, but together, they paint a picture of a market where the physical and paper worlds are starting to diverge. So why is manipulation getting harder? 3 reasons. The transparency problem. Technology has made manipulation more visible. Blockchain-based tracking, better data analytics, and crowdsourced monitoring mean that unusual trading patterns get flagged faster. Retail investors have access to tools that used to be institutional only. Order book data, trade flow analysis, real-time reporting, it's all available now. When thousands of informed observers are watching the same data, it's harder to hide coordinated manipulation. Someone notices, someone documents it, someone posts it, and suddenly the behavior that used to fly under the radar becomes a public debate. The regulators are also more sensitive now. After the fines and the public embarrassment of the previous settlements, agencies like the CFTC are under pressure to prove they're actually enforcing the rules. That doesn't mean manipulation stops, but it does mean the manipulators have to be more careful, more subtle, more distributed. And subtlety is harder to execute at scale. The physical demand problem. The second reason manipulation is harder now is simple physics. You can print paper contracts infinitely. You can create synthetic supply through derivatives and leverage, but you can't print physical silver. And when physical demand exceeds what the paper market can actually deliver, the illusion breaks. Industrial users don't care about futures prices. They care about securing supply. If a factory needs silver to keep production running, they're not going to wait for the paper price to come down. They're going to pay whatever it takes to get the metal. That inelastic demand creates a floor that paper manipulation can't break through for long. And retail demand has become more sophisticated. The average silver buyer today understands the difference between paper and physical better than they did 10 years ago. They've seen the stories about delivery delays, premium spikes, and product shortages. They're less likely to panic sell when the paper price gets smashed because they know the physical market is telling a different story. The concentration problem. The third reason manipulation is breaking down is concentration. For years, a small number of large players held massive short positions in silver. That concentration gave them outsized influence over price. But regulatory scrutiny has forced some unwinding of those concentrated positions. And as those positions get distributed across more players, the ability to coordinate manipulation weakens. It's the difference between one person controlling a large lever and 100 people each controlling a small lever. Coordination becomes exponentially harder as the number of participants increases. Now, none of this means manipulation has stopped completely. It means the effectiveness is declining, the cost is rising, the risk is increasing, and the physical market is becoming harder to control through paper games. Current red flags. So, what does manipulation look like today? It's more subtle, but the patterns are still visible if you know what to watch. Watch for sudden spikes in trading volume during thin market hours. When silver gets hit hard during Asian trading hours, or right before major US holidays, that's often a signal. The timing is deliberate. It targets moments when fewer participants are active, making it easier to move the price with less capital. Watch for coordinated moves across gold and silver. When both metals get smashed simultaneously with no corresponding news catalyst, that's rarely coincidence. The moves are too synchronized, too precise. Someone is executing a strategy, not reacting to information. Watch for price behavior around option expiration dates. There's a documented pattern of price suppression right before major options expire. The goal is to keep as many call options out of the money as possible, limiting the payout to option holders. This happens repeatedly enough that it's become predictable. Watch for the recovery patterns. Legitimate selling pressure tends to build gradually and dissipate gradually. Manipulation tends to hit hard and fast, then reverse quickly once the objective is achieved. If you see a sharp drop followed by an equally sharp recovery with no fundamental news explaining either move, you're probably watching manipulation in action. What happens when control breaks? Here's the scenario that keeps the paper market up at night. What happens when a major player demands delivery on a large position and the exchange can't deliver? There are mechanisms to prevent this: cash settlement clauses, force majeure provisions, rule changes that can be implemented mid-crisis. But all of those mechanisms have one thing in common. They expose the fact that the paper market is not fully backed by physical metal. Once that perception takes hold, confidence collapses. If market participants believe they can't actually get physical delivery when they demand it, the paper price becomes meaningless. Premiums explode. Two-tier pricing emerges. The market fragments. And that fragmentation is self-reinforcing. As premiums rise, more holders refuse to sell physical back into the paper system. As more metal gets locked away, the shortage intensifies. As the shortage intensifies, premiums rise further. It's a positive feedback loop that can spiral quickly once it starts. The banks know this, the regulators know this. That's why there's so much effort to keep the paper and physical markets aligned. It's not about fair pricing, it's about preventing a run on the system. But preventing a run requires maintaining confidence, and confidence is fragile. It's built on the belief that the system works, that delivery is possible, that the paper price reflects physical reality. When enough people stop believing that, the system breaks regardless of what the rulebook says. The manipulation end game. So where does this go? One of three places. Option 1, the manipulation continues indefinitely. The banks get better at hiding it, the regulators continue to look the other way or act too slowly to matter, and the physical market never gets tight enough to force a reckoning. This is the status quo scenario, and it's possible, as long as physical supply remains adequate. Option 2, the manipulation ends through regulatory enforcement. New rules, better surveillance, harsher penalties. The system cleans itself up not because it wants to, but because it has to. This is the optimistic scenario, but it requires political will that hasn't materialized yet. Option 3, the manipulation ends through market forces. Physical demand overwhelms paper supply. Delivery failures become public. Confidence breaks. The system reprices violently. This is the scenario that creates fortunes and disasters simultaneously, depending on which side you're on. We're watching to see which path we're on. And the current behavior suggests we're moving away from option 1. Whether we're heading toward option 2 or option 3 is still unclear, but the status quo is definitely under pressure. What you should actually watch. If you're tracking this, focus on the forensics, not the theories. Watch trading volumes during off hours. Watch delivery data from the exchanges. Watch the spread between paper and physical prices. Watch how quickly dips get absorbed. Watch for rule changes that seem designed to discourage physical delivery. Most importantly, watch for the moment when the narrative shifts. When mainstream financial media starts acknowledging that paper and physical are disconnected, that's the signal that perception is changing. When regulators start investigating current activity instead of just settling past cases, that's progress. When exchanges modify contract specifications or delivery procedures, that's stress showing in the plumbing. The manipulation isn't a mystery. It's documented, it's proven, it's ongoing. The question isn't whether it's happening. The question is how much longer it can continue before the physical market forces a reckoning. And that's the part nobody can predict with certainty. Markets can remain manipulated longer than you'd expect, but they can also break faster than anyone anticipates. The key is understanding the mechanisms, watching the evidence, and positioning accordingly. If you want to keep tracking this with me, hit subscribe and stay engaged with this community. And drop a comment with your take. Do you think manipulation ends through enforcement, market forces, or does it continue indefinitely? I want to hear your perspective.